Okay, welcome back to the show. So today we're going to be doing something that I think is a fundamental of the episode. We're going to be doing a script audit. This is really our chance to put the script to the test. Episode 1, The Lie Hiding in Plain Sight, or What is Money? This was the start of the journey of sort of where conversations with economics has begun for me, and hopefully it's something that will sort of be part of the conversation ongoing with the community, where we look at the scripts and go, okay, what's financially the reality of how the system works, and what is assumptions, and what are the things that we can debate. Because I think it's really important that just to reminder that all the scripts are made with AI, but there's always an element of assumptions built into the way the script's created, but it's always taken from transcripts that I have. The main ones we use is ChatGPT, Grok, Gemini. Haven't used Claude, but maybe we're going to look into that too. So I'm going to jump straight into it. This is a full script audit from Gemini of episode 1. So I'm going to put it up now in real time. So we literally put this together. I've literally asked it to look at the script and put out the main truths in the debatable areas. The main points backed by sources is from the Bank of England, Bundesbank. They represent the mechanical reality of modern banking. Money is debt. So this is the thing that sort of breaks my mind still. When you think about all the money economy once started as a loan from a commercial bank. And it helps to sort of perceive that, because I think the value is in understanding where all money is created. It matters a lot. In our current system, the broad money supply is almost entirely composed of commercial banks, by commercial banks. These deposits are created when banks create credit. They expand their balance sheets on both sides simultaneously. An asset and a loan and a liability is a new deposit. So Richard Werner actually done this in detail. I actually asked a bank to go in behind the scenes, and it's incredibly difficult because no one's really explained this or even proved this system, particularly is that clarity around how money's created is actually when the bank was asked to create a loan, it isn't even a loan in its sense of the word. Without going into that, they are creating new money electronically into the system. And that does really matter when we look at banks and understand their responsibilities and roles. The Cantillon effect was mentioned in this. That is basically the idea that those that are closest, the money sources, tend to benefit first. And it means that people using the workforce and in the sort of mass parts of society tend to sort of get access to capital after some of the inflationary and the sort of effects of that money being distributed. So large corporations, large asset owners tend to access some of those capital and liquidity, for investments first. And that's sort of a pattern throughout economics, and it's not debatable. The historical economic observation, because new money enters specific points, banks, large corporations, and there you go, these entities can spend it before the increase in demand bids up the price of goods, which we'll get to about asset inflation. But credit as a gatekeeper, since banks decide who's creditworthy, they effectively act as de facto central planners for the economy, deciding which sectors. Like, the biggest issue here is that we all would know and understand deep down that assets are inflating. The cost of living is a massive problem, and the sources of where money goes to the economy could be the biggest debate of our generation, because it really will be about who succeeds and who fails in the economy, and whether it could end up being a decline for everyone because of those decisions. The debate areas, well, hopefully there's going to be some of these. Gemini can be our friend or our enemy, which is totally fine. These are areas where viewers traditionally, economics skeptics will likely push back. The created from nothing narratives, of course, here we go. The debate, why accounting credits money from nothing. Critics argue the risk is nothing. It is not nothing. Of course, when money is created, this implies the money is fake. It's not saying it's fake, it's really implying it, or simply the system is based on trust of future productivity. The debate is, banks risk capital in insolvency if loans fail. That is categorically true and would never be debated. They are also restrained by central banks in terms of the reserves, and that is a complex system for itself. The internationality of inequality. The debate, the script claims inequality is built-in feature, designed. I'll put it this way: capital, in its own essence of the word, is capitalism. It is the access to money which matters, which generally sort of creates winners and losers. And if I said, for example, capitalism, the key word is access to money, and if money's skewed in one direction, then what do we have? Would be quite a pragmatic, a bit of a silly question. But when it says extractive by design, if we examine how much money is in the economy, someone has that money, the £3 trillion in the UK. We can't prove it's designed, but it's a cohesive system. It's been like this since post World War II, and it's been gaining momentum. Asset inflation, the breakdown in sort of investment opportunities for small businesses, which are a major employer. You have inequality levels probably similar to this in some regards, almost as bad, and maybe worse in some places, prior to World War One, where there's a massive sort of equalizing effect from war, which is another story for another day. We have to be alert. Technically, we can't prove inequality is intentional, but we can explore the systems that allow it to continue to happen. Oh God, here's the funny one. So the video with the guy. Oh mate, we've all seen those videos where there's a guy who's like, or usually a guy, because their egos get a bit carried away. They're talking about how hard work, the grind mentality. It's great, and I'm passionate for hard work. I've been in business, which is a hustle that can be 100-hour weeks, from the ground up. Without access to assets, and capital, there is real problems for small businesses, which are the backbone of the economy. It is understated to say that hard work, isn't very important, but understated to say that assets and access to capital isn't as important for security for business and for people's and their lifestyles. If you're giving all your money to rent and income when you can't save for a mortgage, then you have exposure to your income. That capital isn't free and investable. There are many overlapping. You all have your own personal relationships with this one, and that video is just funny as hell, saying that rich people have different ways of thinking. Anyway, the hard works is a really delicate frame, and this first episode was majorly heavy with the prompts from AI to come in really, really strong, and we've softened it. Actually, I think some of the tone is exactly, some of the fact in the script is exactly the same. Just the tone is a bit more system based than articulating fault for a particular group, and that's what we will be really careful not to create conspiracy theories. The role of central banks, this is important. We put the pyramid together, the baseline, the workforce. You have commercial banks, you have the central banks, and they have a huge amount of responsibility in stabilizing. And then we have the elite. The elite is just the people who have the most access to probably the political system, institutions that decide on policy, fiscal, monetary policy, if it's government or within banking. The question, are central banks the parents of the economy, or are they trapped by them? That's an interesting question. Some argue central banks try to manage them for public good, but are limited by the tools they have. In future episodes, because we have a lot of these scripted weeks in advance, there is a really good video to look out for in the reaction, and it's showcasing the central banks and how they perceive that they are responsible for inflation, but not the cost of living. And it matters because in this conversation, commercial banks are the creators of money. And if you're saying central banks do not say where to lend, or they call it window guidance or financial guidance from this, central banks, or the large institutional banks, international banks, IMF, BIS, Bank of England, these institutions have their own decisions they're trying to make around balancing the economy, but we have to look at those individual roles, and that's why the pyramid exists. And I think it's a good articulation of that. The structural breakdown: governments printing presses, banks lend out your savings. Cool. These are all things that are good things that are completely transparently explained with truth and facts. I don't think you can say banks are neutral intermediaries and just follow the economy. There is lots of decisions that they make on a day-to-day basis which they're responsible for. Anyway, I think that was a really good example of us looking in. I think we're going to probably cue the AI to hit back harder as well in the scripts, because I want this to be a debate and I want you guys to really get involved in the conversation. It's so important that we do this together. I'm not an expert. I'm merely just trying to articulate stuff I learned from AI, and we can learn together ideally. So do get involved in the comments. The next breakout episodes are coming up, which is the bank versus the state. And this is how those two creation methods of money intertwine together, as well as some really interesting things about how the state's role exists within the economy. Anyway, I look forward to sort of seeing everyone on the next episode, and take care. Speak soon.